Welcome to Value Investing, the Starvine Way, where my goal is to help you learn more about value investing and compounding wealth with a long-term focus. I'm your host, Stephen Coe, founder and portfolio manager of Starvine Capital. I am excited to welcome back a past guest, Christopher Mayer, portfolio manager and co-founder of Woodlock House Family Capital. Chris is the author of 4 investment books, including one titled 100 Baggers, Stocks That Return 100 to 1 and How to Find Them, and is currently working on his next book. Chris, thanks for rejoining us on this podcast. It's a pleasure having you back.
Yeah, good to be back on with you, Stephen.
The purpose of today's discussion is drawdowns, and I read your article, came out last fall, and the timing was quite interesting to say the least. I mean, you can always remember the emotional imprint that it leaves on you. And I remember that time specifically. I actually had a client email me when everything was down, and he said something like, all my stuff seems to be down 20% from the high a few months ago, and I don't see much that's up. And of course, although I might be more immune to it psychologically, I definitely feel and anticipate and think about all its impacts. So can you explain, first off, what is a drawdown and why is it an important concept for investors to understand?
I think a drawdown, I don't know if there's any specific technical definition, but anytime a stock is off its 52-week high, 10, 15, 20%, that's what we would call a drawdown. So what's most important to understand about it is that they are very common, even among the best performing stocks. That was one of the things in my book, 100 Baggers, that study I did. You could see that the best performing stocks had multiple drawdowns where they were down 40, 50% from their highs and still went on to compound at very high rates of return. So that's the important thing. You have to know that this happens. And one thing I like to tell people is a little interesting exercise to go through is just take any of the winning stocks you want and just look at 5-year charts. Just look back and see how many times they suffered through a drawdown of 20 or 30 or 40%. And then it makes you a little more prepared to deal with the next one.
And I understand that this is kind of an interest of yours, drawdowns in particular. What's part of your interest in the drawdowns of these high-performing stocks?
I'm fascinated by it because I know I've gone through my names and I've charted going back 10, 20 years and seeing what the patterns will look like, what drawdowns have been like. I even go back and just kind of look at how many years from point to point where a stock didn't go anywhere. And it's really neat. You draw back and you see what the overall compounded annual return on that stock was over that period of time. So you'll see a stock does, let's say 20% a year over 20 years. But during that stretch, it had multiple times where it was down a third or 40%. So I'm fascinated by that. One, it gives you interesting opportunities to buy these great names, but also more importantly, perhaps, it gives you some resolve to hold the ones that you already own. And I mean, that's the key to these big returns is you can't get shaken out. It's hard to have a 10 bagger, 50 bagger, 100 bagger if you're constantly getting chased out every time the market or your stock falls 20, 30%.
Just so the audience has an idea of how extreme these examples can be. You mentioned Apple, Netflix, and Berkshire as examples, and these are names that most people or most everyone recognize. Can you share more about their drawdowns and what investors can learn from them?
Well, Berkshire in particular is one that maybe it's good to highlight just because most people are surprised to hear that it's been cut in half at least 3 different times. And it was still the best performing stock in the study I did from 1962 to ended in 2014 was the time. And I think it's also important to know that there were long stretches where it went nowhere. For Berkshire, there was a 7-year period where it went absolutely nowhere. So you just think about it. That's an eternity for most people to hold on to something for 7 years that goes nowhere. Because during that time, of course, you hear other stocks that your friends may own that are running, or you watch the news, you hear other stocks ripping and running. And so it takes quite a bit of patience and resolve to just sit with what you have.
Right. And if you look at some other examples like Microsoft, Amazon after the tech bubble in the early 2000s, weren't they? I mean, if your timing wasn't right, you could have been flat or it could have taken up to 15 years to recover.
Yeah.
Despite that, you would have done amazingly well.
Despite that, you still have done well. And then, what you also have to remember, those kind of observations are just like as if you bought it one time and that's it. And of course, that's not how most people invest. You buy a stock and then you tend to buy maybe more at some point down the road. So even if you had bought it near the highs and it took you 15 years to get even, you still would have done well if you held it for the full 20 or 25 years. But if you had bought any more along the way, you'd absolutely crushed it. That's another lesson is when you find these great businesses, to be able to take advantage when they do have those big drawdowns.
And if you can find clients that'll stick around that long, that's a
Yeah, I mean,
long, long
it's not
time.
it's not for everyone. If it was so easy, everybody would have them, right? So it's I talk a lot about different tricks and things that people can do to try to extend their time horizon. I always say just focus on the business, and that's easy to say, but what does that really mean? I remember I wrote a blog post on this a while ago where I just had a table with some key financial data for certain businesses. So you look at revenue and margins or profits or something like that, and you just track it year by year, and you can see, every year it's higher than the year before, and it's marching along. And would you ever sell that stock if you only thought of it as a business, forgetting about the stock price? And the answer is you probably wouldn't. But if you look at the stock price during that period of time, it's all over the place. And that
That's
example
right.
actually, that kind of tip came from Thomas Phelps' first book on 100 to 1 in the stock market. And he did it with Pfizer. He had a nice little table where he just had sales and earnings and ROE, I think, and maybe another data point or two. And in a table, he listed them out for 20 years and asked you, well, if you just looking at this table, would you ever have sold the stock? And of course, you wouldn't have, but lots of people did. And the stock was all over the place. But eventually it was, it was a 100 bagger.
Right. Peter Lynch, I know you're a fan of him. How does his view of staying invested during these drawdowns, how does it influence your investment philosophy?
Yeah, I love Peter Lynch because he was among the first books I read when I was studying The Great Investors. I still have the hardcover editions of Beating the Street and One Up on Wall Street. I still have those books. Those were classics for me early on when I was studying this. Yeah, he says something about stomach being more important in your investing success, not being scared out of stocks. So that's key because, you really can't predict when these stock prices going to go up or down. I mean, it's very, very hard to trade in and out of stocks like that. I mean, you might get it right every now and then, but as a strategy, it's a poor strategy. That's what I tell people. Sometimes they'll look at a stock and it's a great business and it's getting a little stretched on valuation, and then they want to sell it right away. And I say, well, you might be right this time. Maybe you do sell it, and then 6 months it falls. But so what? I mean, what are you going to do? You have to think about it as a strategy that you can repeat. Is that something you're going to be able to do? Is that something you want to do? If you're investing over a decade period of time, do you want to have that stress and trying to figure out and do all those maneuvers over all that time, or just leave it alone? And you're almost always better just leaving it alone.
But just to be clear, you're not saying this about just any stock. I'm sure if most people tried this and didn't know what to look for and held for 10 years, they're probably not going to do well. So you're looking for specific characteristics that make these companies worth holding on to.
Yeah, that's a key point. I mean, for most stocks, you probably wouldn't do this. There's a lot of mediocre businesses out there, a lot of trading stocks that really are more trades. They're not businesses that create a lot of wealth for their shareholders over a period of time. So, yeah, what I'm talking is in the context of my approach of looking for these high quality assets that you can hold for a long time. These are businesses that generate high returns on their capital and have the ability to grow for at least a decade out. And, those are the kind of things I focus on. Great balance sheets where incentives are well aligned. And those are the kind of businesses that I focus on. It's a lot, like you said, most businesses, maybe most, I mean, I think there are a lot of mediocre businesses out there that where if you left them alone, like you say, maybe you don't do so well.
Yeah. I mean, but we're talking about the creme de la creme, right?
Right.
Just to be clear. So speaking of which, Brown & Brown is an example you brought up. It's an insurance brokerage, I think, and it faced a major drawdown during the pandemic. So how did you navigate or think about this period for Brown & Brown? What lessons did you learn from it?
Well, I think a lot of it is what you prepare before you even get to that point, before you even get to the drawdown. So I know the business very well. It's a resilient business. Insurance is a product and this sells insurance to businesses. Insurance is a product that all businesses need. So it's not like because we have a 20% drawdown or something that the business was threatened. And in fact, I remember studying it before I even bought it. I remember looking in 2008, their revenue dropped 1% overall. So that's a pretty resilient, strong business. Man has great balance sheet. The Brown family owns a good chunk of stock. So I have no, real concerns when you have a drawdown like that. I know that the business has been a winner for a long time. I mean, if you look at it, it's just good, steady compounder. So if anything, opportunity like that comes along, it's a time to add shares.
And sometimes what fans of Flames is you'll have a high short interest Have you ever had that? Like you have a combination of a drawdown and you see a very high short interest on one of your high conviction picks, and you wonder, do they know something I don't?
Hmm. Hmm. Yeah, I mean, what's a high short interest? If something has a short interest like 20%, that's
Right.
probably a pretty a signal there's something seriously wrong with that business. But otherwise, I have to say, short interest is not something I generally pay attention to. Again, I'm investing in businesses where there's very little debt. The skin in the game, like you said, the creme de la creme. So occasionally, sure, they may be targets of short selling, but it's not something I tend to think about.
Fair enough.
But you do
So
bring up a good point, which is, the market will test you on anything you own. So you have to think about that even before you buy. You have to think, well, if it drops 20 or 30%, what are you going to do? If suddenly someone were to push back on some portion of the business or idea, would you be able to defend it? Would you be able to think through it? Is that a rational criticism? Is it only part of the story? Is it right? Is it not right? And you have to build that up. Otherwise, yeah, you'll get scared out of things. Somebody's going to show you something. You're not going to know. You're not going to have the framework to properly assess it, and then you'll sell. That's the natural fear emotions take over. Flight.
you emphasize the importance of visually presenting these drawdowns. How do charts and visual data help in this whole process?
Yeah, I use Koifin. They have a great drawdown charting system, and it makes it very clear. You can do it for 5 years, 10 years, whatever you want. And I've run that for all my names just to get a sense. I mean, again, it's surprising the number of times. And what's nice about the Koifin chart is it will show you that time period. You'll see all the drawdowns, and then you'll also see what the stock compounded over that period of time. So you'll see, you can look at it and see, it's had the last 5 years, it's had 3 times, it's been drawn down by at least 30%. And yet still, compounded 20, whatever, 2% over the whole 5-year period. So it's just another way to absorb the lesson. I mean, I guess everyone learns differently. And for me, just visually seeing it on all those names is important. And I have a little saying I like to use also where I just say winners keep winning. Sometimes, you've got a winning business model, great team, those who's been successful for 10, 20 years, unless you have a very, 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 very good reason to think suddenly that's changed, probably better just trusting to that process.
Right. So why do you think investors struggle to remain calm during drawdowns, and how can they develop the discipline to stay invested if they don't naturally have it?
Yeah, I think it's a great question. I mean, there's a lot of reasons. One is a lot of times investors don't really understand what they own. So they may know a little bit. They may know a little bit about the business and what they think, but then they don't really know it. As soon as stock price goes against them, that's their main data point that they have that's irrefutable in front of them. And so they tend to put a lot of weight on that. I think that's one. I think two is that financial media generally, Wall Street generally, it's very short term. The financial industry wants transactions. That's what they want. They don't want you to just sit there and do nothing. They want you to consume their reports. They want you to read their research. They want you to make trades on their recommendations. All that stuff. So it doesn't feed naturally to helping people sit still. And the media too. I mean, it makes it seem like something important happens every day, and it's not the case. Usually nothing important happens in any day, a week, even months. Nothing happens. Even though headlines, I'm glad you think there's all kinds of important things going on. There's economic data out. There's an unemployment report this week. Oh, there's an inflation report this week. But if you have this longer term perspective, those really are not important events, and you can safely ignore them, really. Those are some reasons why. And we have to say some people are just naturally inclined to be very short term. They're that way in their life, the way they think about other things. And so it translates onto the way they invest. And those are the hardest cases for someone who just doesn't have it. The ability to sit still it's very difficult to cultivate. But there are tips and tricks. And one way we mentioned a little earlier, which is to really focus on the business, pull out some key numbers, put them in a table, follow those, and don't follow the stock price. Two is, or don't look at the stock price so much. People look every day. Don't look once a month, look once a quarter.
Easier said than done.
Easier said than done. Yeah. Right. Yeah. I mean, some of this stuff sounds easy, but then you actually do it, it's tougher. So focusing on the business. So, another thing is I like to tell people sometimes, think of it as if you were buying real estate. If you're buying a rental property or something for investment, you don't go and you're not sit there looking at the price every day, every week, seeing what other people might be able to bid for it. You've bought it with a certain understanding that you're going to own it, and it's an investment, And so, give it give it a chance, give it some time. Another thing I like, and I mentioned this in 100 Baggers, is concept. I didn't invent the concept, the idea of the coffee can, which you may know and heard.
Yes, I remember.
Out there. So a coffee can idea is nice. I mean, some people can take some portion of their money and put it in. Well, the idea comes from the old West, where people would store their valuables in an old coffee can and kind of bury it or hide it somewhere, and they would leave it there. So the idea is you translate this to investing is you create a portfolio and some account maybe that you create and you don't look at. And so you do that with some portion of your money and see what happens over 10 years without touching it. So these are some tips that can help people extend their range.
Related to the coffee can concept, didn't Fidelity do a study about who had the best returns over the long term? And it was those that really forgot about their accounts or had died.
Right. Yeah, I've heard of this study. I'm not sure if it's true. I love it. I love the lesson and all, but I have never seen this alleged study, or so it may not be real. But I've heard that as well.
The ability to endure drawdowns is a competitive advantage, to paraphrase what you said before. In your opinion, then, what qualities should investors cultivate to withstand those drawdowns and focus on long-term gains? And can you elaborate on how this mindset benefits long-term investors?
Yeah, I mean, it comes down to patience. Study some of the great investors. If you look at Warren Buffett and read his letters, we talked about Peter Lynch. All the great investors exhibit tremendous amount of patience. And just understand, you're investing in businesses. It's full of people, and they're not going. It's like having a baseball team. You got a bunch of athletes. Even the best on your teams can go hitless every once in a while. They can have slumps, and doesn't mean you go and trade them right away. They'll put in a good season or have a good career. So, it's very similar to that. And try to think of it in those terms.
Chris, thank you so much for rejoining the podcast. I think listeners really gain a lot from listening to you. And to the extent that if you're just promoting a behavior that keeps them from losing money, you've actually benefited them a lot. So, I really appreciate the time that you've committed to this.
Well, thank you for having me on, Stephen. I hope you're right. I hope it helps some people to be a little more patient in their investing, and I hope everyone does well.
Good stuff. Okay, we'll talk soon.
All right. Thank you.
We hope you enjoyed this episode. If you did, please like, subscribe, and share. Questions can be sent to podcast@starvinecapital.com. On a final note, thank you for the online reviews, as that helps us get discovered.